Picture this for a second. You finally decide to get your life together financially. You start doing what everyone tells you is the right thing. You begin saving money. Every month you move a little bit aside. Maybe it's $100, sometimes $200 if you're feeling disciplined. And honestly, it feels good. You feel responsible. You feel in control, like you're finally becoming the kind of person who has their finances figured out. But then one day, you open your banking app, and you notice something weird. You've got $10,000 sitting in your savings account. That sounds great, right? Except it's earning something like 0.5% interest. So after an entire year, you made about $50. That's it. And at the same time, everywhere you look, people are talking about investing, stocks, index funds, compound growth, passive income. And suddenly this thought hits you. Wait, am I doing this wrong? Because here's the truth that most people slowly realize. Saving money is good, but saving alone almost never builds real wealth. And this is exactly where most people get stuck. They understand saving is important, but they have no clear idea how to move from saving into investing without feeling like they're risking everything. So in this video, I'm going to walk you through a simple step-by-step path to transition from saving to investing, without stress, without confusion, and without putting your financial security at risk. Let's start with something that might sound a little uncomfortable. Saving money alone will not make you wealthy. Now don't get me wrong, saving is important. You absolutely need it. But it's not the destination. It's just the starting point. Because saving and investing do two completely different jobs. Saving protects your money. Investing grows your money. And if you don't understand that difference, you end up stuck in one phase forever. Let's make this really simple with numbers. Imagine you save $10,000 and keep it in a savings account earning 1% per year. After 1 year, you'll have $100. Cool, safe, predictable. Now compare that to investing. Historically, the stock market, specifically something like the S&P 500, has returned around 8 to 10% per year over the long term. So that same $10,000, invested instead of saved, could become $11,000 after 1 year. Now, at first glance, that difference doesn't seem life-changing. But here's where things start to get interesting. Time changes everything. Because the real power of investing isn't just higher returns, it's compounding. And compounding is where small differences turn into massive gaps. After 20 years, that same $10,000 in a savings account at 1% becomes roughly $12,000. But invested at 10%, becomes around $67,000. Same starting point, completely different outcome. And this is exactly why the biggest financial gap in life isn't between people who save and people who spend. It's between people who save and people who invest. But here's the catch. Most people never make that transition. And it's not because they're bad at math. It's because of psychology. Saving feels safe. Investing feels risky. When your money is sitting in a savings account, nothing happens. It doesn't move. It doesn't drop. It just sits there, stable and predictable. But investing? It moves. It goes up, and sometimes it goes down. You might open your app one day and see your portfolio down 5% for no obvious reason. And that alone is enough to make people panic. So they avoid investing altogether. And honestly, that fear is completely understandable. You might be thinking right now, okay, I get it. But I don't want to lose my savings. And that's exactly the right mindset. Because the goal isn't to throw your money into the market blindly. The goal is to transition intelligently. And that's why this process needs to happen in stages, not all at once. So let's break it down step by step. Step 1. Build a real emergency fund. Before you invest a single dollar, you need a financial safety net. This means saving at least 3 to 6 months of your living expenses in cash, and this money stays in your savings account. You don't invest it. You don't touch it unless you absolutely have to. This is your protection against real life. Job loss, medical emergencies, unexpected bills, car repairs. Because here's something most people don't realize. The biggest reason people lose money in investing isn't because they picked bad investments. It's because they needed the money too soon. They panic. They sell at the worst possible time. And suddenly, a temporary drop turns into a permanent loss. An emergency fund solves that problem. It separates your life from your investments, gives you breathing room, and more importantly, it allows your investments to actually do their job over time. Because investing only works if you can leave your money alone. And this idea is backed by a key principle. Saving is about safety, while investing is about putting money to work for growth. Once you have that safety layer in place, now you're ready for the next step. And this is where things start to shift. Because moving from saving to investing isn't just a financial decision, it's a mindset change. So now that you've built your emergency fund, we move into what is probably the most overlooked but most powerful step in this entire process. Step 2. Separate saving from investing, mentally. This sounds simple, but it changes everything. Most people treat all their money the same way. It's just one number sitting in one account. And because of that, every financial decision feels emotional. If the market drops, it feels like all your money is at risk. If you invest, it feels like you're gambling with your safety net. That's the problem. So instead, you need to create 2 clear categories in your mind. Bucket 1, safety money. Bucket 2, growth money. Safety money is your emergency fund. It's stable. It doesn't move. It's not there to grow. It's there to protect you. Growth money, on the other hand, has a completely different job. It's allowed to fluctuate. It's allowed to go up and down, because its purpose is long-term growth, not short-term stability. This mental separation is huge because it removes fear. You stop checking your investments every day. You stop panicking over small drops. You understand that volatility is part of the process, not a sign that something is wrong. And once you make that shift, investing starts to feel a lot less intimidating. Now we move to step 3. Start investing small. This is where a lot of people get stuck, because they think they need a lot of money to begin. They imagine investing is only for people with thousands or even tens of thousands of dollars ready to go. That's just not true anymore. Today, most brokerage platforms let you start with very small amounts, sometimes $50, even $10 in some cases. And that changes the game, because in the beginning, the goal isn't to make huge profits. The goal is to build the habit. Think about it like going to the gym. Nobody walks in on day 1 and lifts the heaviest weights. You start small. You learn the movements. You build consistency. Investing works the same way. You're training your behavior. You're getting comfortable with how markets move. You're learning to stay calm when things fluctuate. Because long-term success in investing has way more to do with behavior than it does with intelligence. Now this leads us to step 4. Focus on simple investments first. This is where beginners often make a huge mistake. They jump straight into complicated strategies. Day trading, options trading, trying to pick the next big stock, or chasing whatever is trending online. And it makes sense, right? Those strategies sound exciting, fast, profitable. But here's the reality. Simple investing often outperforms complicated investing. And one of the best examples of this is index funds. If you've never heard of them before, here's the idea. Instead of trying to pick individual companies, an index fund lets you invest in hundreds or even thousands of companies all at once. You're essentially buying a small piece of the entire market. So instead of betting on one company to win, you're betting on the overall growth of the economy. That's called diversification. And it's one of the most important concepts in investing, because it reduces risk. If one company performs badly, it doesn't destroy your entire investment. Now here's something interesting. One of the most successful investors in history, Warren Buffett, has consistently recommended low-cost index funds for the average person. Not complex strategies, not high-risk trades, just simple, consistent investing into the market. And the reason is simple. Because over the long term, the market has a strong upward trend. Not every day, not every year, but over decades it grows, which brings us to what might be the most powerful strategy of all, and also the most boring. Consistent investing. Let me show you what this looks like in real life. Imagine you invest $300 every single month into the market, not trying to time anything, not waiting for the perfect moment, just consistently investing. Now assume the market grows at an average of 8% per year. After 25 years, you'd have around $285,000. But here's the part most people don't expect. You only contributed $90,000 of your own money, the remaining $195,000. That comes from growth. That's compounding doing the heavy lifting. And this is why consistency beats timing. Because nobody can predict the market perfectly, but anyone can build a habit. Now, even with all of this, there's still one big challenge left, and that's emotions. Because investing doesn't feel good all the time. There will be moments when the market drops, moments when the news is negative, moments when it feels like everything is crashing. And this is where the difference between investors and gamblers becomes clear. Gamblers react emotionally. Investors stay disciplined. Let me give you a simple way to think about this. Saving money is like putting seeds into a jar. They're safe, protected. Nothing happens to them. But they also don't grow. Investing is like planting those seeds into the ground. At first it looks messy. You don't see results immediately. And sometimes it even looks like nothing is happening at all. But beneath the surface, something is growing. And over time, that growth becomes visible. And eventually, it becomes something much bigger than what you started with. That's the process. It's not exciting every day, but it works. Now at this point, you might still be thinking, okay, but what if I start investing and the market crashes? That's a completely fair question. And we're going to tackle that head-on in the next part. Because understanding how to deal with market drops is what gives you real confidence as an investor. So let's talk about the thing that scares almost everyone at the beginning. Market crashes. Because at some point, if you invest long enough, it will happen. The market will drop. You'll open your app one day and see your portfolio down 10%, maybe even 20%. And in that moment, it won't feel like a normal part of the process. It'll feel like you made a mistake, like you should have stayed in cash, like investing was the wrong move. But here's the perspective that changes everything. Market crashes are not the exception. They are the price you pay for long-term growth. If you look back at history, the market has gone through dozens of downturns, recessions, crashes, panic-driven sell-offs. And yet over the long term, it has continued to rise. That's the key. Because when you zoom out, those drops that feel massive in the moment become small bumps in a much bigger upward trend. And here's something that most beginners don't realize at first. Market downturns can actually work in your favor. Let's say you're investing consistently every month. When the market is high, your money buys fewer shares. When the market drops, your money buys more shares at lower prices. So instead of seeing a crash as something to fear, experienced investors often see it as an opportunity. They're essentially buying assets on sale. And when the market eventually recovers, as it historically has, those lower-priced investments often generate stronger returns. This is why long-term investors think differently. They're not focused on what happens this week, or even this year. They're thinking in decades. And that shift in time horizon is what creates confidence. Because the longer your timeline, the less individual market movements matter. Now, this doesn't mean you should ignore risk. It means you should understand it. And that brings us to the final step in this entire process. Step 5. Stay disciplined and give compounding time to work. This is where everything comes together. You've built your emergency fund. You've separated your safety money from your growth money. You've started investing small amounts. You've chosen simple, diversified investments like index funds. Now your job is simple. Stay consistent. Because the biggest mistake people make at this stage isn't choosing the wrong investment. It's stopping. They invest for a few months, maybe a year. Then the market gets volatile, they get nervous, they pull their money out. And just like that, they break the entire system. Because compounding only works if you give it time. It's not something you feel immediately. In fact, for the first few years, it can feel slow, almost invisible. But then something interesting happens. Growth starts to accelerate, because now you're not just earning returns on your original money, you're earning returns on your returns. And that's when things start to snowball. That's when your money really begins working for you. But again, this only happens if you stay in the game. And staying in the game is a psychological challenge, not a technical one, because there will always be reasons to stop. Bad news, market drops, economic uncertainty. There will always be something happening. But disciplined investors understand something important. Short-term noise doesn't change long-term fundamentals, and that mindset is what separates people who build wealth from people who stay stuck. Now let's quickly bring everything together. Here's the full path from saving to investing. First, build a 3 to 6 month emergency fund. This is your foundation, your safety net, the thing that protects you when life gets unpredictable. Second, mentally separate your money into 2 buckets, safety money and growth money. This reduces fear and helps you think clearly. Third, start investing small amounts consistently. Focus on building the habit, not chasing big wins. Fourth, keep things simple. Use diversified investments like index funds instead of trying to outsmart the market. And fifth, stay disciplined. Trust the process. Give compounding time to do its job. Because at the end of the day, here's the truth that most people eventually discover. Saving money gives you stability, but investing gives you freedom. Saving helps you survive. Investing helps you grow. And the earlier you combine both, the more powerful your financial future becomes. So if you've been sitting on savings and wondering what to do next, this is your path forward. Not all at once. Not with pressure. But step by step. Because the moment you move from just saving to actually investing, that's the moment your money starts working for you instead of just sitting still. And that's when everything begins to change. If you found this helpful, make sure to hit subscribe and give the video a thumbs up. It really helps the channel grow. And I'm curious, where are you right now in this journey? Are you still in the saving stage? Or have you already started investing? Drop a comment below. I'd love to hear your story.